Welcome to Breaking News to Trading Moves. Today, we're looking at a recent US IPO that's giving us some really clear signals about investor appetite right now, specifically within the healthcare sector.
Right. We're going to focus on the debut of a company called Lumexa Imaging and really what the market's reaction to it tells us. We can use this one event to see which companies are, set up for some gains and which ones might be facing some new pressures.
Okay, so let's set the stage. What are the core facts here? Lumexa Imaging completed its US IPO, and they raised about $463 million.
A pretty decent amount.
Yeah, and the company is now trading on the Nasdaq. The ticker is LMRI.
And it's important to understand the scale here. Lumexa isn't some small startup. We're talking about one of the largest diagnostic imaging providers in the U.S.
How large?
They operate more than 180 centers, I believe, across 13 states. So they're a major player already.
And that's really the key thing for the market, isn't it? The fact that this deal got done and done well, it suggests the IPO window is open again.
Open, but maybe not for everyone.
Right. It seems to be opening for these solid, cash-generating companies.
Especially in what you'd call defensive sectors, like healthcare.
So with that as the catalyst, let's look at the companies that stand to gain from this, the winners. First up seems to be the most obvious group, other outpatient imaging providers.
Exactly. That's the most direct connection. Lumexa's strong performance in the public market, it confirms that investors are really willing to back these large outpatient imaging networks.
And that support from investors allows them to get cheaper capital for expansion, right?
Precisely. That's the key. Cheaper capital means they can use their higher price stock to buy smaller competitors or just borrow more easily to build new centers. It's a huge competitive advantage.
So who does this help besides Lumexa itself?
Well, their main public competitor is a company called RadNet.
RadNet, okay.
Their ticker is RDNT. The validation that LMRI provides helps the whole sector.
And the model is just more efficient.
It's all about cost efficiency. They don't have the overhead of a big hospital, so they can offer an MRI or a CT scan for, sometimes 40 to 60% less.
The market is rewarding that efficiency. So if these providers are winning and expanding, they have to be buying things.
They do.
Which brings us to the second group of winners, the imaging equipment and software makers.
Yep, a classic supply chain effect. When a network like Lumexa gets a big infusion of cash from an IPO, the first thing on their shopping list is capital expenditure.
More machines.
More MRI scanners, more CT scanners, and all the software you need to run a network that large.
So this is an immediate boost to the order books for the big vendors.
A direct boost. The material points to two in particular. GE Healthcare Technologies, the ticker there is GEHC.
GEHC, they make the big scanners.
They do. And also Hologic. HOLX.
Hologic, okay.
They're a leader in certain types of diagnostic equipment and software, so when the big networks have cash to spend, their sales get a nice lift.
Right. And then there's a third winner here, which is a bit broader. It's the financial ecosystem itself, U.S. capital markets and the deal makers.
Yes. Every time a decent-sized healthcare IPO like this gets done successfully, it just helps build confidence. It reinforces the idea that the U.S. IPO market is getting healthier.
And the direct beneficiaries are the exchanges and the banks.
Of course. The exchanges get listing fees.
And Lumexa listed on the Nasdaq, so that's a win for them. The ticker is NDAQ.
And the banks that handle the deal, like Jefferies Financial Group, ticker JEF, they own those big advisory fees.
So it's a confidence booster for the whole financial machine.
It creates momentum. One successful deal makes it easier for the next company in line to go public. It reduces that perceived risk.
Okay, so that covers the winners. Now we have to look at the other side of the coin. If these efficient outpatient centers are gaining, that must put pressure on someone else.
It does. And the first group feeling that pressure is the hospital-centric providers, the ones that really rely on their own in-house imaging departments.
So we're talking about the big hospital chains like HCA Healthcare?
HCA, that's HCA, and Universal Health Services, UHS, are two good examples.
And what's the core issue for them?
The issue is that routine imaging is a high-margin business for a hospital. But as more and more of these non-emergency procedures shift out of the hospital and into these cheaper outpatient centers,
the hospitals lose that volume.
They lose the volume and they lose the revenue. If a patient can get the same scan for hundreds of dollars less down the street, why wouldn't they?
And hospitals just can't compete on price because of their massive overhead costs.
Exactly. Their fixed costs are enormous. So the success of LMRI just throws a spotlight on that cost difference and intensifies the pressure on hospital volumes over the long term.
Okay, that makes sense. Now, the second group facing challenges is completely different. It's not in healthcare at all. It's the high-risk tech IPOs, things like AI, crypto, and fintech.
Right, and it's about investor sentiment. When a stable, cash-flowing company like Lumexa does so well, it kind of resets the bar for what investors want to see in an IPO.
They want profits now, not promises of profits way down the line.
That's it. Caution is still the word of the day for those more volatile venture capital-backed stories. If your business model depends on burning cash for years to achieve scale, the market is telling you that strategy is just too expensive right now.
So this sentiment can hurt the fundraising plans for companies in those sectors. We're talking about companies like SoundHound AI, ticker SOUN.
Or even SoFi Technologies, SOFI.
SoFi, right. The market is demanding that proof of profitability today.
The money is there, but it's flowing to business models that have already proven they can generate cash.
Okay, and there's one more group facing some headwinds here, and this brings us back to healthcare.
It does. We're talking about the smaller diagnostics and outpatient players, the ones without enough scale.
So this is a direct competitive threat from Lumexa.
It's a classic consolidation story. When a big, newly funded player like Lumexa emerges, it creates a real challenge for smaller rivals.
Because Lumexa can use its new capital to either buy them up
or to just outcompete them. They can leverage that strong balance sheet to undercut smaller players on price to gain market share.
which squeezes their margins.
It squeezes their margins and really reduces their bargaining power. This could even affect larger, more established players.
Like who?
Well, think about Quest Diagnostics, that's DGX, or LabCorp, ticker LH. They might now find themselves competing against a very aggressive, well-capitalized new network that's hungry for growth.
So in this environment, scale becomes everything.
Scale, network density, and access to cheap capital. If you're a mid-tier player, your position just became a lot more vulnerable.
Okay, so to wrap this all up, the Lumexa IPO really highlights a clear preference in the market right now. Investors want large, established, cash-generating companies, especially in a resilient sector like healthcare.
Right.
And that trend is directly helping other outpatient providers and their suppliers, while at the same time putting pressure on hospitals and smaller diagnostics players who can't compete on scale.
And that leaves us with a final thought for you to consider. If this investor confidence keeps favoring established scale and profitability over more speculative growth, what other defensive, cash flow positive industries might be next in line for their own public offerings? Think about utilities or maybe mature infrastructure companies following this same successful blueprint.
This is not financial advice or buy or sell recommendations.
Yeah.
This is purely the opinion of the author.